All right, let's talk about a big one. One of India's most recognized household brands is finally hitting the stock market. Yep, LG Electronics India has officially filed for its IPO. So the big question is, what's really under the hood here? We've dug through their official filings to give you the complete breakdown. Okay, so here's how we're going to tackle this. First up, we'll get into the LG India story. Then we'll crunch the numbers. After that, it's all about the strengths versus the risks. You know, the two sides of the coin. We'll size up the competition, break down the actual IPO offer, and then wrap it all up with a final takeaway. Let's get right into it. So this really is the core question, isn't it? I mean, you know the brand, I know the brand. Many of us probably have an LG product sitting in our homes right now. But here's the thing. Does a famous brand automatically make it a great stock to own? Well, that's what we're here to find out. Let's dig in. All right, first things first, let's set the stage. We're talking about a market titan going public. Now, you might think of LG as this global giant, and you're right. But its story in India, well, that's a story of pure market dominance. And honestly, that's a huge piece of this whole IPO puzzle. And when I say dominance, I mean it. They're not just a player in the market. They are the leader. We're talking number one. According to their own prospectus, LG India holds the top spot in key categories, like washing machines, refrigerators, and panel TVs. So let's be clear, this isn't some up-and-coming growth company. This is an established giant. So where does all the money actually come from? This breakdown tells the story perfectly. You can see that massive slice right there. That's home appliances and air solutions. We're talking fridges, washing machines, ACs. This is the real engine of the company. It brings in the lion's share of the revenue. Now, home entertainment is still a decent chunk for sure, but their core strength, their profitability, it's all about the appliances. Okay, so being number one is great, but how does that translate into financial health? A strong market share is one thing, but you know what they say, the numbers have to back it up. So let's take a look at their financials over the last 3 years. And wow, these figures, pulled straight from their filings, they tell a really clear story of growth. You can see the revenue from operations has been climbing steadily. But look at the profit for the year. That's what really caught my eye. It's grown even faster, jumping from around 13.5 billion rupees to over 22 billion in just 3 years. That's not just growth, that shows some seriously impressive operational efficiency. And this chart just makes that upward trend crystal clear, doesn't it? What you're looking at is steady, consistent growth. No big dips, no major bumps in the road. This really points to a company that has solid demand for its products and, just as importantly, tight control over its operations. But, you know, impressive growth is only half the story, right? Every single investment has risks, so we absolutely have to look at the other side of the coin. And what's interesting is we can see the potential challenges the company has highlighted in its own prospectus. So, on the one hand, you've got these incredible strengths. We're talking number one market share, massive brand trust, and a distribution network that's just everywhere. But then, on the other hand, you have the risks that they've laid out themselves. A really high dependence on their Korean parent company, the volatility of raw material prices, and of course, just intense competition from other global players. Okay, let's zoom out a bit and look at the playing field. How does LG India actually stack up against its peers? I mean, being the biggest player is great, but are they also the most efficient? Let's size up the competition. Now, this peer comparison is really telling. Take a look at the return on net worth, or RONW. That number basically tells you how well a company uses shareholder money to make a profit. At over 37%, LG India is more than twice as efficient as some of its listed peers, and the profit margin is higher too. This means they're not just bigger, they're actually more profitable, keeping more of every single rupee they earn. All right, so we've got a good handle on the business now. So let's shift gears and look at the IPO offer itself. What exactly is the deal on the table? And maybe most importantly, where is all this money going? Okay, listen up, because this is a really crucial detail. The LG India IPO is a 100% offer for sale, or an OFS. Now, in simple terms, what that means is that LG India isn't raising any new money for itself to grow or expand. Nope. All the money raised from this IPO is going straight to the pocket of the parent company in Korea. So here are the nitty-gritty details. The parent company is selling off just over 101 million shares. Mark your calendars. The IPO window is set to open on October 7th and close on October 9th, 2025. It's going to be listed on both the BSE and NSE. And of course, this sale will bring the parent company's ownership down from the full 100% it holds now.
So, we've looked at the business, the financials, the risks, and the structure of the deal itself. It's time to put all the pieces together. What does this all mean for you, the potential investor? Let's frame the final decision.
So, what's the verdict? Is this a huge opportunity or maybe one to watch from the sidelines? This is the question you have to ask yourself. Because on one side, you have this top-tier, market-leading company, but on the other, you have an IPO structure that has some very, very specific implications. Let's boil it all down. The proposition here is pretty simple. You get to invest in a market leader with rock-solid financials. But what's the catch? Well, it's a 100% offer for sale, which means the money isn't funding future growth in India, it's going to the parent company. So you're basically weighing a dominant brand and proven profitability against those key risks we talked about, the dependence on the parent company and some really tough market competition. Look, the official prospectus for this IPO is over 400 pages long. We've tried to give you the highlights, kind of like the first 5 pages, but this is really just a starting point. The next steps, well, they're yours. It's so important to do your own homework. And of course, just a quick but really important reminder, this breakdown is for informational and educational purposes only. It should absolutely not be treated as financial advice. Everything we've talked about is based on publicly available data. You should always do your own research, or even better, talk to a certified financial advisor before making any investment decisions.